Hello, and welcome back to another week of your Mortgage Market Movers Weekly, where we are detailing everything that's going on in the macroeconomy to help you make better home buying decisions. This week was a pretty big week, and I purposely waited to do the video after the big FOMC meeting that happened on Wednesday. That's been the thing on everybody's mind, and if you have been paying attention at all to the economic landscape, you are aware that there was a big meeting where there were expected Fed rate cuts. So we're going to dive deep into all that during the full-length video, but just in case you want to head out after the intro, the 30-year fix is sitting at a 6.26, which is a good bit down from where we started earlier this year. That's down from last week's 6.34, I want to say, somewhere around there. Anyway, so yeah, we are going to dive into the FOMC meeting, what was said by Powell, and how this impacts rates going forward. So let's dive on in. The charts. So the first thing that you are going to notice on this chart is over here. We are at the US 10-year, and if you have been following along with us, then you know that the US 10-year is what we use to track the 30-year fix. It is the proxy. Typically when the 10-year is falling, the mortgage rates will also fall. All right. So we had a low back in April, and mortgage rates were probably at their, no, not probably, but they were at their lowest this year in April. That was short-lived. It was really only for, they got that low for about a day and then started climbing up fairly rapidly. And ever since then, we have been coming down till we got around here. Now, in this area right here, rates have kind of sustained, and that is from around the beginning-ish of September till about now. And it has been rates kind of yo-yoing around in the same area. Now, we had the FOMC meeting, and what's important to take into consideration is that this meeting is when the Federal Reserve will determine whether or not to cut rates. They are not cutting mortgage rates. They are cutting the federal funds rates. And this is really the, it's like the borrowing rate. So when they cut rates, it typically is good for the interest rates. It's not necessarily the case that they will definitively help mortgage rates, as we'll see in a second. But typically it's good news. And, cutting rates, it allows for companies to borrow money at much lower rates, which is typically good for businesses. So like home builders and everything like that. Even Powell said in his press conference that they do not determine the mortgage interest rates. However, cutting rates typically does help mortgage rates, though it's not necessary that it does. Anyway, enough yapping about that. We can look at the bonds and see that the bond market was rallying since September 2nd, and that's where we see really this big drop. So we see big rise in the bond market. The TLT is what we use as a proxy for that, and then we see the curve right here where it's starting to curl over. Same thing with the 10-year. We can actually take a look at a little bit more in depth. We can see that people were really buying into the bond market, and then the 17th was the day of the FOMC meeting, and rather than a big green candle, which would have resulted in a lower US 10-year, which would have resulted in lower interest rates, we got a red candle. So we're going to look into that. But one thing that I do want to point out with the market, right? And we have to think about the bond market, the stock market, all those markets when we take into consideration mortgage rates. They all kind of play a role. Is that the market is a forward-looking mechanism, and really it works off expectations. So let's see. We can go to, I don't know if this will still have it, but you can go to this little tool, and yeah, it doesn't have the meeting date because it already passed. But there was like a 95% chance of a cut that was going to take place to this 400 to 425. And now there's a 91% chance of a cut in October, and then a cut in December. So the market is pricing those in. The market expects those things to happen. And so it was not going to be any big surprise. Oh my gosh, the Fed cut rates. Let's buy bonds. Let's go crazy. People were buying in anticipation, and that is likely one of the reasons that the bond market saw this rally. It's the anticipation that the rates were going to get cut. They did. Now, it's also important not just that they cut rates, but it's important to look and see what Powell actually said. And you can see this. This is the summary of economic projections, I believe, or this is their press release. It's one of those. Anyway, you can see it's important to take into consideration the kind of overall economic picture. Investors might get spooked by things like higher inflation. And when we look and see what Powell discusses in the press conference, what he released to the public, what the Fed released to the public in their press release, uncertainty about the economic outlook remains elevated. We can see that inflation has moved up and remains somewhat elevated. So really, this signals that the economy is not where the Fed wants it to be. And that's one of the reasons for cutting the rates. So we see that the labor market has kind of broken down fairly severely. There were revisions to numbers that had already come out, and those revisions were not good at all. We can take a look at that. But the labor market does not appear to be holding up great. So job gains have slowed, and unemployment rate has edged up but remains low. So the Fed is still saying that, it's not spiraling out of control, but things don't look as good as they were looking earlier in the year. And inflation is still up, right? So their dual mandate, the Fed has two goals. They want to keep unemployment down and inflation down, right? Inflation was supposed to get to like a 2% target, and it does not look like it is getting there. So the committee is attentive to the risks to both sides of its dual mandate, which is unemployment and inflation, and judges that downside risks to employment have risen. So saying that unemployment is not getting to where they would like it to be. So these are the things that investors take into consideration when looking at whether or not they want to buy bonds, right? So, bonds are IOUs, of course, and investors, don't like uncertainty when it comes to bonds because they're supposed to be a safer asset. So that is what happened with the FOMC meeting and why I believe that rates did not come down as much as everyone thought. Everyone was like, oh, rates are going to come down to, I don't know, maybe someone thought they were going to get back down to 2 or 3%, but no, not that low. But we have seen rates come down. So that's not to say that now is not a great time. If we just, like I said, we can look at the average 30-year fixed, and this number is probably going to come up slightly next week. Or it might stay around there, but 6.26 is definitely a lot better than where it was in January at 7.04. That's almost a full percentage point. And this is the average 30-year fixed rate. I believe they get these numbers by, based on applications submitted to Freddie Mac. Okay. So anyway, that's a lot of talking. Let's get into the rest of the video. The core retail sales, looks like retail sales are doing well. We had, of course, we had building permits and housing starts, and these were lower. So looks like less houses were being built last month, and new residential building permits issued lower. So less housing going on, not super great. We don't really want to see that going on. We had unemployment claims came in at 231, so lower than the expected 241. Let me see if I can find to the revised. I don't know. Maybe was that this? I don't know. Oh well. Anyway, the revisions to labor data showed that the labor market is not doing too hot. Well, we really just have to keep looking at the data, see what comes up, and see if this is a transitory thing or a long-term thing. And that's what the Fed does too, right? It just looks at the data, and that's how they make their decisions. But we should expect, hopefully, two more rate cuts this year. So that'll be a total of 3. And the market is still ripping and roaring, right? So bonds, it's not as if bonds crashed. They were up fairly high. They were fairly elevated, and they've come down a bit, but it's not, they haven't crashed down, and that's why rates still, are pretty decent. So let's see. All right. Next week, we have what will be important to us. We'll check out new home sales. Final GDP is important to look at, and unemployment claims too. We'll see existing home sales and core PCE month over month. That'll be interesting. It's always good to look at stuff like personal income and personal spending, see how consumer habits are. But yeah, that's kind of the spiel for what's going on with the rates and and really my opinions about what's going on and why the rates did not drop significantly. So yeah, great time to refi. If you bought earlier this year and you had, up in the 7s or so, it really would not be a bad idea to consider at least consulting with a loan officer to see if you could be saving money monthly, because why not? Everyone could use a little bit more cash in their pocket. All right, that's going to do it for this week. So if anyone has any questions, give us a call at 877-TEAM-MBL or visit us at www.mortgagesbylynda.com. Have a great week, and we will see you next week. Bye.